Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Wednesday now. I kind of feel like we missed the beginning of the week. It went by too quickly, guys. And I don't know. There's not as much fun in the rest of the week, this week at least. Here, let me show you here in the charts. Let's go over here. Well, let's start with the treasuries. Yesterday, there was some decent downside action. They bounced back hard, but then faded all the way back down to the lows. Oh, wait, hold on. I forgot. We got it's like some news. We're going to get housing starts, building permits, etc., here. Okay, so the building permits was 1.65. Housing starts change was -0.7 versus a 1.5. That would be dovish, but the market still seem to be reacting to it too hard. Okay, so here's what I see. Here yesterday, some aggressive downside action, taking us to, below some key levels here. And now we're still below it. So we're kind of in a situation where we could have another doozy down move, okay? It's a little more sensible here in ZB, right? You can see the line. They might push it through there, although I would really expect that when they get there in the 30-year that there's going to be some resistance, right? E-mini doing pretty good. I mean, they're a little bit off of the all-time high here, but yesterday was an okay day. I didn't really see any key catalyst. I think that market thinking maybe Baynard was going to get. Man, the squawk. I don't want to talk. I don't want to hear him right now. Hold on. Okay, I think that the market. I was certainly thinking that they were going to announce Brainerd yesterday. They didn't do it, and then Biden came out and said in the next 4 days. So I think somebody kind of screwed up there. Probably the chairman that said that it was imminent. Okay, but maybe that increases the chances of it being Powell. Okay. So that was kind of my theory about why that was happening. As such, though, we can see we're down overnight. It might be a little bit of a difficult day next 3 days in equities because of that. Okay. Oil has been moving, but it's still within its range. Natural gas had a little bit of a scare with the Russian pipeline, but it came back to a reasonable level. The gold and silver, well, they kind of came back. Okay, yesterday gold took a bit of a dive when the rates increased. So we are still getting this rates increase. Gold and silver get hurt, but then gold and silver will recover other times and go higher. And the things still look pretty good in gold and silver. Silver looks like it's doing a little bit better, in fact, wouldn't you say? So yeah, we got that. Copper's still struggling. Okay. That seeing copper struggle kind of concerns me. That seeing copper struggle and gold and silver doing well is screams stagflation in my mind. Okay. Bitcoin took quite a doozy of a move yesterday, and you can see them struggling to hold that 60K up above it for now. Some buy the dip moves there. I'm a little concerned. I mean, yesterday there was a lot of reports of liquidations on the exchange, like trillions of dollars in liquidations. So that kind of suggests that they've got it was a manipulation move and that they're going to buy the dip. But I'm a little concerned about what fundamental reasons might be behind that drop. because it kind of seemed like it come out of nowhere. All right. So there's two possibilities there. It's more likely that it was just a manipulation move and that they're going to move higher. Okay. Dollar is coming back a little bit, but I mean, come on, now to 96. So it's really, this is kind of the one that's I think, I'm not going to say it doesn't make sense, because I think I understand why we're seeing that move into the dollar. You know, people want their money to be over here. But if inflation is the big problem, how do you have a strong dollar like that, right? So that one gets kind of interesting. So we want to continue monitoring the dollar closely and the Japanese yen. You can see here off of this latest news, the housing starts and everything. We did see a little bit of an up move in the Japanese yen, and the treasuries move up a little bit. We'll see if they can maintain that momentum. Now, how are you guys doing this morning? It looks like we're going to have another quiet morning. So if I want to come back over here, not that I don't want you to come and watch my stream and everything, but I'm a little, what is the word, sanguine, whatever. I'm a little down on our chances for the rest of the week. Come on, this week up things. There we go. Okay, so today we got a bunch of Fed speakers. So for us in treasuries, we could still have some action, right? A lot of that doesn't start until after we're done trading. So tomorrow, Philly Fed manufacturing index and the usual unemployment claims. Philly Fed is not normally a really big mover, but the manufacturing indexes have been more influential lately. Then we got some more Fed speakers in Treasury current report. So here, going into the end of the week, it's pretty light on news, right? Except for maybe Brainerd, which he was saying in the next 4 days. So does that mean 1, 2, 3 Saturday? Come on, right? And then apparently we have a really, really big gamma position on in the treasuries in particular. Like the CTAs are like 100% short, and there is a ton of gamma expiring this weekend, which means that we could get more volatility next week. But that also means that in the meantime, I'm a little bit iffy on how much movement we'll get before then. Eric H just says, for a friendly reminder, fundamentals are a meme and that markets only go up. Well, it's not that. It kind of, it really comes down to what your definition of fundamentals is, because fundamentals is about like the underlying value and financials of a company, right? Well, what matters is orders, right? So you can use fundamentals to predict future orders. There are things that you can kind of do that do that, but that is not like all fundamentals. And this is why you get this seeming contradiction where markets don't line up with fundamentals very frequently. But if you take it from the approach of what creates new orders, you'll find that new orders is always able to explain why the markets moved the way that they did, even in Bitcoin. Did I say trillions in liquidations? I don't know how much. It was a lot. It was a lot. Part of it may have had to do with the network upgrade too, but where did I see it? Man, I'm pretty far down the list now and I'm not seeing it. Liquid. Oh man, baby is very unhappy. That sounds. Maybe it wasn't that. Maybe it was the Bitcoin subreddit. She got him. She got him. No, I can't find it. There was a Coinbase withdraws nearly 1 billion. Ooh. Man, does he need a milk? I might go and check. Maybe I should just search Bitcoin liquidations. Daily liquidations near 1 billion. Okay, there you go. There you go. Nearing 1 billion. Okay, so here in the treasuries, I would say that the actual cumulative delta is a little bit iffy. I am seeing maybe a little bit of flattening in the 2 and 10. Okay, so that was a pretty aggressive uptick. Pretty aggressive looking uptick, but it was kind of, well, did my 30-year reset here on us? Let's reset things. They renamed the stables. Didn't that happen a long time ago, though? It sure feels to me like a top could be getting close. Like I said, there might be a more fundamental reason for why Bitcoin dropped below 60K. If rates are raising and the way that the dollar is going and everything, there might be some institutions that are trying to play it as a hedge and might have taken significant selling, but I would think that this is more likely like a liquidate all of the longs, spike price back up again, get everybody to FOMO in for the final exit. Because if we're worried about the Mt. Gox thing, the end of this month, right? You want to be out before then, which means that you would want to be exiting in the next week. And if you have a large position, you're going to have to do it over time. So how do you make that sort of move so that you can exit, liquidate all the longs, and then spike it back up? You think maybe they're idling because we have several Fed speakers today? Yeah. No, I'm a little I'm a little mixed on today, because I see that too. That probably a lot of the bigger players in treasuries are just gonna kind of want to see what happens. But we did get some decent movement just then, right? And we are kind of in some interesting places, technically speaking, compared to yesterday. So, and they have been reacting to some of these levels, you know, and especially given where ZB is at, you know. It wouldn't surprise me to see them go to the lows of the day and just, like, you know, fall out and then recover, sort of a thing, you know. Plus, it's Wednesday. A lot of money tends to get distributed on Wednesday. But when I watch this order flow right here, that's not dead. That's not the best bid at 5.5. But I wouldn't say that they're dead right now. Well, so like when you look at the chart here, so yesterday in the 10-year, there was kind of this area at 130.08 that had been defended a little bit. When they failed that yesterday, that was when you saw them extend quite a bit lower, but then they recovered it. Now we're below that in the overnight session. So now you're kind of looking at 129.31.5. All of a sudden looks like, whee, you know? And then same over here in ZB. In ZB, it's 159.18. So it's right around the overnight lows. If they fell through, you know, and that could be a situation where you should see extension, right? Like I don't try and look at the levels like there's a greater chance of them hitting there and moving, but that's that. You know, if I see flow there at that location, it means that somebody cares about it. And then it's kind of down to the situation to sort out what's going to happen. Right now, I don't have any fundamental reason to think that they're really going to move, especially since they didn't do Brainerd yesterday. Like the Senate Finance Committee chairman said that it was imminent. So we thought maybe it would be in the next day. Then Biden came out and did damage control and said in the next 4 days, which if they had already made the decision, why the next 4 days? You know what I mean? So we should come back. I said I was going to look at that. If we come back to predict it, people have been playing this one. People have been playing this one. Powell is still on top, but you can see Brainerd gaining. And that, man, I sure hear a lot of whispers speak about it's going to be Brainerd. So probably a good trade if you were big would be long Brainerd over here and go short the Treasury over here. Yeah. Maybe that's not such a good trade because we're moving up right now. And that might not have anything to do with Brainerd. Now, at the same time, that move that we have may have been they already bounced and it's just going to be an up day. I mean, that's the flow is definitely saying up right now. BlockFi is in a bad position due to their Grayscale Bitcoin trade. They took your Bitcoins, deposited to Grayscale to get GBTC, hoping to sell GBTC for more money after the lockout expired. This trade blew up in their face, and GBTC is negative to Bitcoin. They can't return your Bitcoin. Oy. if BlockFi can't bring in new money to their Ponzi scam, they're pretty much screwed. That being said, crypto firms have bailed out their own using customers' funds from other crypto firms. It would be interesting to see if BlockFi gets a crypto bailout too. Breaking new motion. Kenosha prosecutors withheld video evidence from Kyle Rittenhouse defense team. That'll be interesting. You know, they didn't have, it felt to me, and maybe I'm wrong, but I was browsing TikTok and YouTube, and there was live streams on the Kyle Rittenhouse thing. And it kind of felt like they were expecting the jury to come back and give their verdict like any moment now, you know? But I kind of thought that it usually takes them at least 1 or 2 days, even if it's like quick. Am I wrong on that? I don't know enough about juries. I feel like I have a pretty good handle on how certain kind of cases tend to go and stuff, like, the news cycle around them and stuff. But I don't know about the psychology and tendencies of juries. But today will be day 2. Will they come in today? I don't know. That's interesting, though, that headline is coming out now. Kenosha prosecutors withheld video evidence. Okay, well, Treasury's backing off there. So that makes things interesting. Now, I can see the 2 and 10 year spread moving, but not the 30. Not the 30, 10, 35. Well, with that fizzling out there, that really kind of decreases my chances of doing anything today, wouldn't you say? I'm gonna have to be careful here, because I think if they really did like truly fizzle out there, it could just be pullback. But if they really fizzled out there, then the next thing I would expect them to do is to go back to 03 to try and convince people to go short and then flip back on them there. Like they could just do the back and forth. Well, we have a 20-year bond. That's a good point, too. What do you mean, how many are there? So the 20-year bond, I'm not so sure about, because in the past we had some really good auctions, and then we had some really bad auctions. But I believe that the 20-year is not special in repo, right? 20-year is the one that's not special in repo, and therefore had like a really bad demand last time. That there's lots. Especially now. And man, have you noticed that ever since they passed like that last stimulus bill, there's way more frequent auctions. It used to be it was like a once a month thing, and now it seems like it's every 2 weeks. They're definitely issuing more paper. Which really kind of starts to boggle the mind when you realize that like the Treasury market was kind of experiencing a shortage in treasuries because the Federal Reserve was buying them all up. Just like, wow, they're buying a lot of stuff. That can't go on forever, though. One of the things that I'm starting to see millennials argue, and I think that it's a really good argument, and it is very much an evolution in the public discourse, is they're saying, like, boomers will complain that millennials aren't responsible with their money, and that if you stopped buying a coffee every day and all of that stuff, then you would be a millionaire. And then they turn around and they say, so where's your $1 million? How come you're still working? How come you haven't retired yet? Well, number one, every generation is irresponsible with money. Okay. Every generation, there's a reason why they had to make Social Security a thing in the first place. It was because people weren't saving enough and then were destitute in their older years. Okay. And the elderly were literally living in the streets. Well, now there's another problem, and that is, I would be considered a millennial, yeah, because I'm 35. Am I 35? 36. No, I'm 37. I'm 37. No, I'm 36. It's 2021. So I'm 36. No, so I would be considered a millennial. Anyways, my thoughts seem a little disjointed today, don't they? I didn't wake up very well today. I don't know what the deal is with that. Body must have been just recovering, I guess. Anyways, so the millennials turn around and they say, how come you're not rich, right? How come you're still working? Well, here's the thing. If you're a baby boomer and you're like in your 50s and 60s, you probably want to retire. But number one, no, people tend not to save up enough, right? Probably us, we might find we don't save up enough. But what do you do when the interest rate is 1.5%, right? There's no way that these baby boomers can retire and live on their savings when the interest rate is when you're literally losing 4% on the year from holding government bonds, right? Like, these low interest rates is a real problem for savers and for elderly people, right? So here you got all these problems with, like, they're having trouble hiring people, and millennials aren't getting the kind of the promotions that they think they deserve, and it's because the baby boomers are staying in their jobs. And why are the baby boomers staying in their jobs? Because the interest rate is too low. Kind of, and millennials are starting to catch on to this, and they're starting to go, oh, there are real societal costs to low interest rates. You get what I'm saying? You're old when you can't remember your age, right? That's the plan for them to never retire. Maybe. The reality is that Social Security was always meant to be a safety net and not your whole retirement, and that the amount of money that you have to save in order to retire comfortably is way more than people expect or can handle. Like, I'm looking at it, I don't think that you can just max out your employer's 401k contribution match and retire off of that. Because, like, I'm looking at it, and it's like you'll have a few $100,000 by the time you're 60. It's not enough. They just keep buying QQQ. Right? Well, I think that's probably why a lot of millennials are starting to get involved in the stock markets, because they're realizing that in order for me to really make enough to retire, I'm going to have to put more into actual stocks. And I'm going to have to get more than that 7% year over year gain. I say 7% because that's what it tends to be after taxes. Yeah. And before you realize the next step is YOLO your money on Wall Street bets, TEDx. That's exactly what they're doing, right? Isn't it kind of funny how that works, though? Like, think about it. 5% year over year inflation. Now, they say that that's transitory. But let's just assume that it's not, because I think a lot of people don't believe that. Probably it is transitory, but a lot of people right now, they don't believe that. How are you going to beat that 5% year over year? You're not going to do it with any kind of safe investment. You got to put it into stocks. And it's not even that simple, because I have some stocks that are doing, I did the Zillow thing. That's dismal. Man, that one looks terrible. There are a lot of small cap stocks that were really looking great the beginning of this year, but then the environment kind of changed and they're getting beat up right now. When the Shoeshine Boy gives advice to JP Morgan or whatever. Yeah, no, it was actually JFK's dad. It was where that story came from. My understanding is that the origin of that legend was that it was JFK's dad was told that by this shoeshine boy just before the Great Depression, and that's how his dad was able to get so rich, was because he got out at the top. The EV mania, yeah, the EV one is a little zany, but again, it's like, it's this dichotomy between fundamentals, right? Fundamentals don't move price. Orders move price. If you're shoving all of this money into the stock market and then you have like a retail trading frenzy, then the price of all the stocks are going to go up, and it's not going to be in line with the fundamentals. And you know what? It doesn't have to be. It frankly, it never has to. There's this idea that like eventually things have to come back to the fundamentals. I mean, over time they tend to, but there's no reason that they have to, because as long as the orders keep coming, that can be maintained, right? You don't have a problem until the orders stop coming and they start being sell orders. Well, when is that going to happen? Never, if they keep the monetary policy the way that it is, right? So it is a mania, but at the same time, it's not. It's not a mania in the same way that like the late 90s was. That was truly driven by just like investor psychology, whereas this one, I really think that people are doing the only sensible thing given the environment. They might be getting led into a trap, but it's like the only possible alternative. And the money has to go into stocks, right? Where else are you going to put it? You say orders move markets, but fundamentals can move orders. Well, they can. They can. That's a big, right? The relationship between fundamentals and new orders is kind of an odd relationship, isn't it? Changing fundamentals can cause people to submit new orders, yes. And that's and you can find good trades off of that. But I think that what we're learning is that there are other things that affect new orders more, right? They can literally go in and Goldman Sachs is putting out these reports where they go in and they estimate how much money is going to be put into the stock market month by month. And when you get a market where like not everything is great, like on the surface, it seems like everything is great, but you got to realize there are some stocks that did get hammered this year, right? There are stocks that are down. So that kind of just moves even more money into the ones that are winning. I was just reading a Taleb tweet, but it wasn't. It was kind of meh. That's why I chose my words, yeah. You said can move orders, yep. But it's kind of funny, though, how people kind of get stuck on that particular thing. I really feel like it's somewhat intentional. It's like the professionals know that orders move markets, but they also know that if they told the public the reality and what works, that the public either won't believe them or will kind of hate them for it, right? Because knowing that orders move markets leads to a couple of conclusions about how markets and capitalism works that are not the utopian vision that most Americans have in their heads, is it? Especially my friends on the right, because people want to have this idea that the market is always right, which maybe from an investing perspective is like one way to look at it, is like that thing went up, so the market is right. I should have been in that thing. Okay. But the reality is that the market's not right. Okay. The orders move markets. So if we're the ones that are causing that stuff to happen. And if we allocate our capital into foolish ventures, for instance, we put all of our money into an electro vehicle company that's never made any money before, right? And we make it the most valuable company on the market, even though it might be worth something, we're putting too much capital into that thing, and we're going to have to pay the costs of that. We're the ones that are making it happen. It's not efficiency. People think that if the market did that thing, then that was the correct and efficient thing to do. It's not the case. The market can be wrong, and the market can be wrong for very, very long periods of time. And why don't people want to accept that? Because once you realize that, there's only one conclusion. When things go wrong, who's responsible? We are. We as a society have collectively made investment decisions that were bad for society, right? And who else can you blame but yourself? We don't want to do that. We want to just go and make money, and when it has negative impacts on other people, you just say, well, that's what the market wanted. Don't argue with That's why they don't want to accept it, I think. That's my theory. I mean, there's probably lots of reasons. I think that there's also kind of some cognitive reasons why that's just not the way that people want to work. Because the other side of it is that if orders move markets, then how do you deal with that? You have to work. You have to do your work to be able to be a good investor or a good trader. That means that you have to put in the work. You have to know what's going on. You have to be able to predict what other people are going to do. And people would rather say the market is efficient. I can just follow what the market is doing and look at a chart and have absolutely no clue what's going on and make money. And people want to believe that very, very, very strongly. So the type of person that gets into trading really wants to believe that, and it's just not the way that things work, right? Price is what you pay, value is what you get. Yeah. I think a lot of people, like, one of the things I've been seeing in the cryptocurrency field is, they talk about value, and it's like NFTs have value. It's like, just because somebody paid money for it doesn't mean that it has value. I think that is a misuse of the term value. To me, value as it pertains to securities means future cash flows, right? Could I be wrong? No, it's the market. Yeah, well, the market can be wrong. I'm just saying. People have billions of dollars invested into an asset class that is essentially a Ponzi scheme at this point and is based entirely on fraud. And if that ever unwinds, they're all going to be completely screwed. Can you sit down and say then, oh, the market is right? Yeah. The market is right until it changes its mind, I guess. But that doesn't mean that you're going to be free from the consequences of it. Markets can't be wrong or right. Sure, they can. Let's define what is wrong or right. Okay. Can markets make there is a decision. One decision will be ultimately good for the society and good for the economy, and one decision will not. Sometimes the market will choose the one that is not. That is the market wrong. A certain asset can be in a state where it is overbought, or it's going to have a collapse is imminent, and the market is allocating money to it, when in the future you as an individual can know that that asset is going to be bankrupt in the future, and you might have to wait for a catalyst in order to see that thing happen, and you might not know when it's going to happen, but you can certainly make these kinds of calls where you know that it's going to happen at some point, and everybody that has their money invested in that asset is going to lose their money. That to me is the market is wrong. There can be a situation where a piece of breaking news comes out and the market makes a move in a particular direction, and it's because the market completely misunderstands what the news story is. And then as people kind of sort it out and actually start to understand what it was, the market will have to go back the other way. That's the market getting it wrong. If you say people are moving markets, then you can't blame markets by saying it is wrong or right. Sure, why not? But see, this is the problem, is that the market doesn't have a mind of its own, right? It's only doing it's only a reflection of the orders that we put into it, right? And if we, the people, put in the wrong orders, then the outcome of the market is going to be the less optimal outcome. You cannot. I don't think that it's the right way to look at it to say markets decided that Elon Musk should be the richest person in the world. That's not what happened. You guys decided that Elon Musk should be the richest person in the world. It was investors investing their money in Tesla that created that to happen. And whether or not that is a good thing or a bad thing for the world is up to you as an individual to determine. But you can't just turn around if it ends up being a bad thing for the world by saying, well, that's what the market wanted. Then don't invest your money in fucking, overvalued Tesla, guys. Take it's all a diversion to avoid taking responsibility for our investment decisions. You get what I'm saying? You might never have all of the. Sometimes you might have enough information to say it was bad, right? If something keeps, like Bitcoin keeps growing for the next 100 years, listen, it could keep growing for 100 years. That doesn't mean that it's the best way to do, that it's the correct thing. Okay. It's not. If people are willing, no, you see, you're conflating making money with being right. Just because a particular thing made money doesn't mean that it was the right thing for society. You could have collectively as a society made a different decision, and that decision would have been different orders, and you would have made money in a different way. And then you would be saying that that was right. As it's almost like it, because I don't know how else to interpret that. It's just reflecting what people are choosing to pay for right now. Yeah, but how is that right or wrong? Do you see that the market? I guess you can say current price is not right or wrong. Is just a reflection of the orders that people put into it. That would be an accurate statement. Yes. But as to, does that price accurately reflect all available information? No, it does not. Is that price an accurate reflection of the value that particular asset provides to society? No, it is not. And if you get a price movement, is that price movement always indicative of the reality on the ground? No, it is not. And that's where I say markets can be wrong. Markets can be wrong, and if you just try and follow them, then sometimes you're going to be wrong. You're going to lose money from them, right? But maybe the more effective phrasing is to just go back to the more solid argument, which is the markets are not efficient, right? That's the thing. But again, that's my argument. Markets are not efficient. Why do people want to believe that markets are efficient? They want to believe that markets are efficient because they believe that if markets are efficient, that absolves them of responsibility when markets go awry. More to the point, you say you're a big investor, right? It's a common thing for a big investor to come in and say, well, don't blame my fund for this financial crisis or whatever it is. That's what the market decided. No, that's not how it works. You made the investments. You caused the market to do that particular thing, and you are responsible for what happens. Okay? Elon Musk is responsible for the decline in the price of Tesla because he sold his shares. Whether that's, you can argue whether that was a good or a bad thing, but the price decline was because of him. His orders were the reason that it moved. Who gets to decide? Well, there is a right and a wrong. Right and wrong are fundamental concepts that are self-existent in and of themselves in my philosophy. So there are decisions that can be objectively considered right or wrong decisions. I think, for instance, it is fundamentally wrong to base our society on a currency that, basically wastes electricity. That's not an efficient use of our resources. It's not going to be a very stable economy. It's probably never going to happen. But there are a lot of people that want to try and make it happen, and they're putting their money and their orders in there to try and make it happen, and it's the wrong decision. And who gets to decide what's right or wrong? I did. I'm saying it's wrong. I'm saying that kind of waste of resources is wrong. Yeah, I am. Yeah, he says fair enough. Yeah, but you know the kind of person that I'm talking about, though, right? Because if that is what takes over, and then we end up in some sort of a global crisis because of Bitcoin usage, right? And what are people going to say to justify it? They're going to say, well, don't blame us, all of the people that invested in Bitcoin, that it was the market that did that. No, it was you. You were the ones that invested into it and made it a thing, and ergo created all of that energy usage and are therefore to blame when it ends up being a problem. Right? You know that person. You know if there's a problem with Bitcoin, there's going to be people that'll say that, right? Don't blame us. It's just the market. No, it's you. You are the market, you morons. But this only matters in that these are. I mean, what are we doing? We're taking what we know about markets, right? Because we know something about markets that apparently the majority of people on this planet do not know, right? Orders move markets. It seems to us like such a trivial and stupid, nonsense statement. Of course orders move markets, right? I feel personally attacked. I don't know. You've played it. I don't know. But look, I played the cryptocurrencies too. I don't know. Let's come back in 6 months and then we'll see how we feel about cryptocurrencies, right? Because if the cryptocurrency advocates are right, then we're going to be up at $100,000 per Bitcoin, and they're all going to look really nice. And if they're wrong, it's going to crash 90%, and they're all going to look like idiots. And I personally think that if we have a crash, and the crash happens because fundamental weaknesses of Bitcoin are exposed, such as Tether, then it might not come back. It may never come back in quite the same way. I wouldn't even say that that's like the all-time high per se, but it would be like, like let's come in here, like it'll be like this. Either way, I'm going to try and make money out of it. No, it'll be like this. The peak for Google searches in Bitcoin was back in 2017. We're actually not getting more searches for Bitcoin now. It'll be like that. It'll be like, it'll come down. Maybe price will recover, but it'll always be like that because less people will be interested in it because of what happened. Like I really think that at some point that's going to happen. And I really think that if there was a collapse in cryptocurrencies because of Tether, that's what would happen. And that the amount of money, you know, like I'm not so sure that the 2017 bull market would have even happened if it wasn't for Tether. You know, like if the government had stepped in and had implemented enough regulatory controls to prevent fraud in the cryptocurrency space, you know, if they had started to make the moves that they're making today and they had made those back in 2015, okay, then that whole bull run probably wouldn't have happened and this bull run probably wouldn't be happening. It would be a completely different world, right? And we're only able to say that because we understand that orders move markets. And so we can go back into another world and say X thing happened, there would be different orders. And so this is how that would have changed the price of this asset and what kind of cultural impacts that would have had, right? People that don't, because a lot of people don't believe that orders move markets. They think that the markets are an accurate reflection of all available information. If you believe that markets are an accurate reflection of all available information, then there aren't really those alternate realities, right? Because the price will always accurately reflect the underlying knowns. And so the only way that you go into an alternate reality is when that underlying information is different. And I suppose it would kind of, you could say, well, yeah, but that underlying information can include new orders, but it doesn't for starters. But I find it hard to believe that Tether collapsing is not priced in by now. Okay, so this is actually a really good example, air cages. Some things can't be priced in. Hold on. Knowledge of future orders does not necessarily prevent those future orders from occurring. Makes sense? You can, so for instance, it's March 2020. Everybody knows that Congress is going to do a stimulus. Everybody knows that the Federal Reserve has put an unprecedented amount of monetary stimulus into the S&P 500, okay? Why doesn't, at that point, the S&P 500 instantly spike to 5,000? If you were to factor in all available information accurately, knowing what we know now, why did it not go to 5,000, which would be the price that you could calculate just knowing how much money was going to be put into the markets because of those decisions, right? Because knowing that it's going to happen does not prevent the future orders from actually happening, right? You can know that those future orders are going to come in, that money is going to be pushed out of bonds and into stocks, and that the low interest rates is going to help tech stocks. You can know that all of those things are going to happen, and you knowing and trading on it does not affect those future orders from actually coming. Sometimes it can. Right? Like if I have a, the jobs number, if I know what Thursday's jobs number is going to be, the jobless claims, and we all trade on it and we think that it's going to be a bad number. So we all trade on it and we move the yields down. And then when the news comes out, because we've already moved it, it's all based on our expectations. So because we all already expected that thing to happen and traded on it, then when the thing comes out, we might actually get the opposite thing, because what matters? The orders, right? And so we typically think of that. We think something gets priced into the market. That can happen. A thing can be priced into the market. The orders have already come, and therefore when the event happens, you won't actually get the orders that you expect because everybody already traded on it, right? But there are other situations where that is not the case, especially when it comes to government interventions. The government interventions force certain orders to happen. And you can literally just front run it. So in the case of Bitcoin, in Tether, I would argue that it is the other one. That if Tether collapses, that those orders will come and there's nothing you can do to stop it. And it doesn't matter how much people price it in. The only way that they could price it in is stop using Tether. If everybody stopped using Tether, then it'd be a different thing. But they can't, right? That's where all of their money has come from, and if they all tried to get out of Tether, they would realize that the money's not there. So in that particular case, accurately pricing in a collapse in Tether would cause Tether to collapse, right? Well, I think that we made a pretty good call when the Treasury fizzled out there, saying that they weren't going to really move. Now we've got the equity markets opening, so we may see a little bit more movement from the Treasuries. We would tend to see that around this time. But it still looks pretty meh. It looks like up, but pretty meh. Now, here's the real question off of all of what we've said, is can we, at this current moment, make decisions or make predictions about orders that are guaranteed to happen that can't be priced into the market? Can we right now at this time? Well, in equities markets, I think it gets a little bit more difficult, doesn't it? Because we're going to have interest rates rise, and stock prices are already so high. There's a lot of question about what kind of return we can actually get in the next 10 years from stocks now because of all that, right? But here's one. Treasuries overall will sell because there's going to be less orders buying treasuries, and the Federal Reserve is going to have to raise interest rates. And so that there's going to be selling in treasuries. In the long term, in the next 2 years, I think you can sell treasuries. This is kind of where yield curve trading, you start to realize there's some real advantages to it, because you can kind of make those decisions in certain cases where you can say, yeah, in the short term, we know this is going to happen, but in the next 30 years, we know this is going to happen, and you can trade the curve based off of that. Of course, you could be wrong about what those orders are actually going to do, but if you have a correct understanding, then you should be able to predict it. Finex has written a Medium article about the Fidelity stablecoin that does what so-called stablecoin issuers claim is impossible. How is that? I haven't heard about that Fidelity had a stablecoin. We hear a lot from so-called stablecoin issuers that they can't do audits because so-called stablecoins are such a new and innovative concept. We also hear from these issuers that the breakdown of their reserves must be a total secret. We hear terms such as commercially sensitive commercial paper. But what if I told you that there was already a stablecoin that showed you that these issuers are completely full of crap? Well, it's called the Fidelity SPAXX. The Fidelity SPAX is an instrument available on Fidelity that exists to park your cash when you're not invested into a stock, much like Tether is used to park your funds when you're not speculating on cryptocurrencies. Fidelity gives you the option to use SPAXX or FDIC, so using SPAX is optional. One of the pitfalls with SPAX is that it's not FDI insured like so-called stablecoins. SPACs provides a breakdown of their reserves without the New York Attorney General having to sue them first and fight them in court for 2 years. It's right there in the fact sheet. How novel. That's okay. I see the point that he's making. Good uptick. You think that we could see a little bit of a run here? Yeah. Okay. 07. 5 years definitely driving it. Looks like up is the trend for the day. I don't know how much it will continue. We might look back at this and be like, oh, I wish I had traded this. Like, that's a good 2 ticks there. 07 and 07 half, maybe 08 if it's, so I'm kind of tempted to take 07 half. Let's see if we get 08 before 07. So not enough for me to go and even put a sim order on it, but excuse me. Markets only go up. It's just simple. They do in this environment. District leaders are now speaking out about dual crisis. Oh, that's my school district. What? Oh, okay. There's rampant bullying at their school. Well, I do not have very much confidence that they will handle that issue correctly. Well, it looks like you did not get the 08, so glad I didn't take it. The market year says your kids are already in the metaverse. Yes, they're playing Roblox. There you go. Okay, now that one was a little bit better of a tick, wasn't it? That one you might, if you had taken the edge on that one, you might get. It'd be hard though, only 1,603 contracts, right? So you probably wouldn't have caught the edge on it. It looks okay. I think we might get a little bit more upside action, but it's still a little bit iffy, isn't it? It's still a little bit hesitant. It kind of seems like it's taking a little bit of coaxing for them to continue pushing into those highs. Now, we are seeing selling in the S&P 500 here, right? That we may be seeing some of this action in the Treasury may be flight to safety because of the S&P 500 going down. And I'm not sure if the S&P 500 going down is going to continue. I don't see a strong reason for equities to be selling today. that could just be kind of like the little move that they tend to get, and then you buy the dip, right? Can someone explain the metaverse? Sure. So the metaverse is a protocol, an open protocol that any developer can plug into to have a virtual presence. So think of it as like EverQuest, except for that anybody can build something on top of it. Or like, let's go back. There are virtual reality games that exist. For instance, VR chat. VR chat is the most popular of this. And in VR chat, you can go and you can create a level. You can create user avatars that they can use and things like that. But it's kind of like a centralized thing. But what if there was an application where the whole thing was open source and all of these modules connected together in a way that everybody was connecting to? Because with VR chat, there's still a little bit of centralization to it. So the metaverse is really like decentralized VR chat, right? And then and that's the main thing. But everybody's getting excited about it because there was this movie called Ready Player One where there was a metaverse and everybody played this game. I actually think that our concept of a metaverse is a little bit better because be more flexible, but their metaverse was kind of centralized in some respects. But it's a bubble, is what I would say. I think it's a bubble. I don't think that where VR technology is at right now, that many people are going to want to get involved in it. It's not really the immersive experience that people think it's going to be, and it's kind of weird. At best case scenario, it'll be kind of like the Wii, where there will be a period where everybody thinks it's really, really cool, and then they kind of get bored of it. So you notice you don't see very many people go and play their Wii every day, do you? Right? Like, the thing that's cool about the computer is that you can just sit there. Why would I get a helmet and these gloves and a treadmill and all of this stuff? It sounds cool, so this is the future. Mark Zuckerberg thinks it's the future. I'll be that grumpy old man that thinks it's stupid and would rather just sit in front of my computer rather than go and buy the treadmill so that I can have the full VR experience. I am realizing now I am that guy. When you were a kid and there's that 35-year-old guy, he doesn't like the kids walking on the grass because that's what he cares about, is his grass being super nice. You know, I don't really care about my grass, but there are other things that I care about, right? That's me now. I'm the grumpy old guy that doesn't like the way that things are going and gets mad at the kids for it. I know metaverse coins are pretty hot right now, but I didn't really do my research. It sounds like a fad. Well, yeah, but that's the way that you got to do it in cryptocurrencies, right? Right, Air Cages? Like, in cryptocurrency, you got to determine what is the trend, what is the fad that the cryptocurrency world is going for, and then go and find the projects in that fad that are the best positioned, and then wait for one of them to pop off when the money comes in. And you just have to be aware of the fad early enough to get in on it, right? The fad used to be CryptoPunks, now it's Metaverse. Yep. And who knows what it will be after that. I guess I haven't really thought about it that hard because I think that the thing that comes next is a crash. But I've been thinking that there's a crash for a long time, and there can't be a crash unless Tether won't let there be a crash, and I do think that Mt. Gox selling could be enough to overcome Tether, though. So there you have it. You could have gotten a fill at 08. It would have been a little iffy taking the one tick from 7.5 to 8. And more so, it's a little bit iffy to be like, we could have taken 65. But when I'm looking at this and I'm like, okay, so there was a little bit of a move. Was there something that I could have done differently to have, made that move? Well, obviously I could have sold it, but why would I have sold it? And I think the only reason that I was seeing at that time that could have been a reason for me to sell it was that the trend was up in the treasuries. When I say sold it, sold the 10-year. And the trend was up over here, but there's no way for me to have known that it was going to continue up or reverse or what. So I totally ignored NFTs, for example, because I couldn't convince myself to pay for JPEGs. I missed out and probably skipped the metaverse coins as well. Well, the metaverse coins are probably a little bit of a different thing, though, right? Like, The problem with NFTs, here's the problem with NFTs from a trader perspective, okay? There's too many of them. So your chances of catching one of those few NFTs that ended up being worth $1 million is really, really low. Only a handful, only a few hundred people actually caught one of those out of what is now millions of NFTs that are out there. When it's a coin, you're usually able to go out and there's like a dozen coins. Like if the next boom, I think that there's already kind of been a boom on that, but the next boom could be tokens related to decentralized services. So tokens that allow you to that allow you to do actual calculations or to store things, file coins, Sia coin, that sort of a thing. Maybe let's just say, for instance, that's the next trend, right? There's only so many of those coins out there, and you can kind of sit down and say what's the best one and put some money into it and go and mine it practically for free and make $1,000 out of literally nothing, right? You can do that in an NFT because there's like literally thousands, if not millions of choices. But the metaverse thing is different because it's not even really so much coins as it is picking a game. So you can just go and pick a game that you enjoy and play the game that you enjoy. And hey, if that coin isn't the one that takes off, at least you enjoyed playing the game. I think that would be a great way to play it. It's just that, from what I understand, all of the games that they've made so far suck. But hey, maybe a good one comes out. I'm worried that on that one, what will happen is there will be a game that will come out and it'll get really big, but it will get big so fast that you won't be able to jump on fast enough. And there will be tons of false starts, other games that seem like they're going to do that and go nowhere in between then. And so you'll put all of this effort into like 5 different games and nothing ever turns out. And, but then the other thing is that I think that a lot of these games seem to be lending themselves towards RPG kind of games. And I don't enjoy those. I just don't enjoy those. Well, 30-year So we are getting a little bit of steepening again today. 30-year seems to be leading a move back down. So I think we are still in the, yeah, probably makes sense given the current environment to just not do anything. It's okay. We're having a good discussion here. I appreciate you coming in visiting me again, Eric Ages. I'm wondering what was it that made you think of me today and yesterday, because it's been a couple of months. Now, maybe the up action is the 20-year auction. Then maybe that could have been a reason for us to go in and favor along. Well, if that is the case, we could maybe still justify a trade and to try and get $10, especially if we were able to get a pullback maybe to like 65 or something like that. I figured out the way to make money from NFTs is to create and sell. Well, yes, but first thing is that going to continue? I don't know. Because I'm seeing stuff on TikTok where they're like, okay, here's what you do is you make this asset, and then this thing will randomize it for you and create 1,000 different NFTs from it. Like, what? And then you have to go and you have to market it and everything, which is like, ugh. But the point is that to do the NFT thing and have some success with it, there are some skills that we may not necessarily have. I'm not a very good graphic designer, nor am I a very good marketer, unfortunately. I need to figure that part out. I don't know. Well, we are working on it. On the channel, my current thinking is I've got about 5 or 6 videos in my mind that are like evergreen content ideas that it's like, I don't care how engaging the video is or any of that. All I care about is that the information is presented effectively. So I'm spending a lot of time writing the articles and doing a teleprompter so that you watch these videos, you're getting good information. And then I'm putting the articles on Medium. You can go and find me on Medium and you can find those order flows like the scripts written out instead of having to watch the video if you want. Just wanted to check in. It's been, thank you very much, Arcages. I appreciate it. You've always been there. Well, not from the beginning, but from when we started live streaming at least. You always come back. I appreciate it. Anyways, so I want to get those ones out of the way. Once I get those ones out of the way, I think that the focus turns into current issues and trying to be engaging. How do I do that? I don't know. I think that sometimes I'm not very engaging. I've just decided, and I don't know what to do with it. Sometimes I think, well, maybe it's just the niche that we're in. But then I go, yeah, but you can definitely expand your niche. Ace must be short somewhere. Maybe he would be. It was earlier in the week when taking his trades, it was being a little bit difficult. I would have thought that he would have made the short off of that first move on the open and then maybe already be done. But it was a pretty good down extension for sure. It's definitely well below. I mean, well, geez. If we come back into ES and we start looking at this, like what would be like levels that they would start looking at? And they would, like key levels would still be quite a bit below us, like in the 60s and 70s still. I'm not seeing any real news pushing it. I do see that some central bankers, the ECB and the Bank of England, are talking right now. Yeah, But that's why I'm saying that, like, on this move, I don't know what he would have done. Would this move right here have been enough for him to take profits and then be done for the day? I don't know. Because that was a good... that was a good 5 or 6 points back. But it's just I think it's really important to realize that with the way that they're doing it, where it's coming in at is you're trading at the beginning of the session and you're scaling contracts to take on risk in a certain fashion. And so we're speaking of him in past tense because he hasn't been here the past 2 days. And the day before that, I was quite upset with him. And quite frankly, I'm still upset with him. Because, so this is going to seem really stupid, but to me it really matters, okay? Well, I mean, it's not really, it's really stupid. Like, it's not a reason to, like, disappear and go away. But it is a reason for me to dig in my heels and be mad. So the argument was, the S&P 500 and the NASDAQ are highly correlated. That was the argument, right? So first off, it's dumb because he's so very clearly wrong, right? Like, why would anybody try and argue that there isn't a correlation between the two of them? I mean, they share a ton of, the same stocks and stuff. There's going to be correlation, and we know that there are tons of robots and firms and stuff out there that are just arbitraging those indexes and stuff, right? Like, that's how they make their money, is they are using statistical arbitrage. Can you make money doing that too? I think probably you could. I don't know if it'd be worth the effort, but I think probably you could. But if you're just trading with discretion, is it something that you might want to keep an eye on? Yeah, I think it definitely is. But Ace doesn't seem to think so. Ace seems to think that all you have to do is say it's kind of going this way and take a trade and let it run. And his argument is, well, I've made money doing that, so that's the golden standard of proof of something. And that's fundamentally flawed for a number of reasons. Okay. The first problem is that past performance is not indicative of future results. Right. The second problem with it, though, is that when you look into that kind of a system, it's not entirely clear where the profits come from. So, are the profits coming because there is a real edge in trying to follow a trend change in the S&P 500? Well, every kind of empirical study that I've ever done on it says no, there's not. He hasn't, I don't know if he uses a different signal now. He's not using the crossover of the 10-minute moving average. Does it matter he is making money? It does matter. 100% matters. Because, again, him making money from it doesn't mean that you trading it, you're going to make money doing it, right? And more to the point, again, where are the profits coming from? Well, you're taking multiple contracts. All of them are going to stop out at one level, and then the rest of them are going to run. So here, we'll do it right now. In fact, because I'm kind of okay with where it is right now. Just take right here. Okay, so I have 3 contracts on, and I have one. Yeah, it was a 10-minute moving average. It was a simple 10-minute moving average, and he was combining it with like a volume weighted moving average. That was his old one that he wasn't using anymore. he was combining it with a weighted moving average. But, when I back tested it and everything, it didn't work. It was essentially random. It didn't work even when I added like the scaling in and stuff like that. But obviously that thing takes more traits than he does, right? So what does that tell you? If he's making money off of it, it's largely because of the taking on the risk, at least from what we can tell. Yes, so it was over the NQES correlations. So here's why I have a problem with it. If you're not going to trade based off of empirical evidence, then what the hell are you doing? Right? If I can come in and I can say the market has a tendency to do this, and I can incorporate that into my trading, or if I know orders move markets and I have information that gives me a good chance of being able to predict what the futures or orders are going to be able to do, like that's something. But if you don't have empirical evidence, then what are you actually doing? You're just risk taking, right? You say he's making money, but I'm not entirely sure, Lucas. Everyone who trades on risk, yes, but some strategies are only making money from risk. Well, that one didn't work out. And if you're only making money from risk, you kind of have a problem, right? Because it's going to blow up. You can deal with it when it blows up, but I'm just saying, he acts like, oh, when I see X thing and then I do it. And that's like, hey, we can make a robot do that. And then you go and you backtest it and it doesn't work. And then they say, well, the backtesting doesn't matter or whatever, because no. How do you know that he's not just pulling your chain? Because you don't necessarily know. Well, I don't actually think that that's the case, Lucas, because he'll call his trades, but then you'll have periods where he doesn't really call them, and the market is choppy, and you don't see him. Like, I don't know, man. I've never seen more than like a 1 or 2 month period of trading, so I can't go back and say over the past 2 years has he made money. He hasn't shown me that. But again, like, past performance isn't indicative of future results. So why should we believe that it will continue to be profitable? Especially if, when we go and we do a statistical analysis of his entry signal, says that it doesn't work. You get what I mean? Not having a statistical edge, you're not trading, you're gambling, and that can be an addiction. Well, listen, you can make money from taking on risk, but there are serious downsides to trading in that manner, right? Which one? I don't think I recall what you're talking about, Kalud. Backtest your pulling, stacking, hypothesis. Wait, maybe if you explain it again, if I had said that, I must have had a reason to believe, based on our current knowledge, that it wouldn't necessarily work. But I also would think that I already had stuff that you could test it with, right? Well, no. Why does that matter, Lucas? Hold on a second. Why does it matter? I don't think you understand the contention that I'm making. It's not about whether or not you're making money or not. Because, again, you can make money and be lucky, right? There are people that have traded before, don't know squat, got really, really lucky, are millionaires now from trading, And if you try and duplicate their trading methods, you will fall flat on your face. Why? Because the reason they made money was because they were lucky. It's perfectly plausible they could, yeah. I mean, he hasn't given us enough information for us to really verify that, right? Yeah, he's only ever shown me a month. I said, well, you show me a month, that's fun. But I've always kind of taken the position of like, I'm again, the what is the key idea here that I'm trying to teach people, that it makes me mad when he tries to undercut it. And quite frankly, he's always trying to undercut it. What, okay? Use empirical evidence to trade. Ace's argument is, forget all of the empirical evidence, just do what I'm doing and you'll make money. In a short term, price moves the path of least resistance. That's true. Price pulling from asks and stacking on bids, market moving up. Ignore market order quantity for now. Look at limit orders. Yes. Generally speaking, so if we were to go back and we did a study and we said price changed, what was the bid and the ask just before that price changed, you would almost always find that if it ticked up, that the bid was stronger than the offer and vice versa. That's very much true. Now, I can come in and I can make something where I look at the book and I say, what is the balance between the book? Like, add all of the bids together and add all of the offers together. Or maybe I even just only look at the inside one and I say, okay, if this is bigger than this, then I buy. And then if it changes, this is bigger than this, then I sell. I've actually done that. And what I found was that it kind of helped, but that it seemed like you would need a more complicated system to go on top of it. You get what I mean? Okay, so what is deeply flawed about the last video that I posted? Would I like to know? But that's the thing that, again, that I'm trying to get at here is that I'm saying don't use this thing in your trading because I made money with it. I mean, look, I'm not making millions of dollars. I've done pretty okay since the micro treasuries have come out. I've had some, you know, I'm actually quite grateful. This, like, even though I made some really dumb and big mistakes, I'm still doing okay with it. And I am paying for costs, right? And I think that that's a really good starting point, okay? I don't come out and say, I've been doing so great, you should follow me because of that. There's a fallacy in that. And frankly, when you take that kind of approach to, I'm just going to go and look for the person that's claiming that they are making money and seems to have the best evidence that they're making money. And I'm telling you, if you go and you try and follow that person, you're probably not going to duplicate their success. Okay? So you need to take a different approach. Don't try and follow other people. Don't try and copy other people's method. Try and come up with your own method based on empirical evidence. We can prove that there are certain behaviors in the markets. It's not the sort of thing that most people think about. Like most people don't think about what is the relationship with large meta orders, and realize that it follows the square root law. Like, that's not the sort of thing that most people would even think to look at. But there's a lot of research on it, and it's very well established that happens. If Yeah, I'm gonna let Lucas expand on that first before I try and respond to it. But that is how is that different from what I said? How do you catch the edge? The way you catch the edge is you hit into it just as it's about to leave. Okay, we can go. The first thing that you said, I don't see how that's any different from what I said in the video. No, so you say you never hit into bids / offers when working with the spread. What you are saying is you don't use a market order. And in my opinion, if you're not using a market order, then you're not catching the edge. You're after she goes. That was a good little move up there that we just had up though. By the way, wasn't it? I think that okay, he says yes, that's why. Okay, so again, if I'm teaching them catch the edge, that's a setup, right? There's an edge in hitting into it when the offer is small, like right here, in that you have a greater chance of those limit orders being exhausted and having a position that's you can instantly hit back into. That's the edge. And then see what you're saying on that one. You're joining bids offers when size goes against you, which is a big no. No. I disagree with that. Okay, so and I can prove that one. Okay. There is a slightly higher chance of an iceberg holding. It's a super, super tiny chance, but there's a slightly higher chance of an iceberg holding. Like that's straight up the way that it works, right? I mean, obviously, if you're getting a really strong move against you and then there's an iceberg there, it might not be a very wise thing to hit into it, right? Or to join that iceberg, right? Well, I actually, you actually can very much make it work out. So, I don't really trade this one very often, but if you are just trying to make a tick, you can very much join the iceberg and take the one tick on the back tick. That one actually works really well. In fact, that's kind of what there's this one student that John Grady was interviewed that's kind of what he was doing, right? Maybe it was a little bit different from that. Maybe he wasn't joining the iceberg. Maybe it was outside of that, but no. Well, the thing is on that video, because it did talk about catching the edge, which is something that he talks about in his video, but I was talking about I was giving a lot more information, and I'm trying to give people this larger view that might not necessarily all come together until the very end. Does that have any? Yes, it does. So what we were doing was very early on. The way that I learned this was we would have. I would use one range charts, right? I would use a one range charts, and there would be situations where so when you do a one range chart, now all of a sudden you basically in the 10-year you're doing a one range chart. Then when you look at the delta for that one particular range, what it really tells you is how many orders it took to move price up or move price down, right? And so I could go in and I could say, okay, if it took X thousand to move the price through and I faded that, what was the chance that you'd be able to catch a winner? And there was a slight edge in it. Wasn't enough for you to want to take the trade on its own. But you realize, like, when those icebergs happen and there's all sorts of volume around them, why do you think that volume happens? It's because there are robots that take trades around that activity. And one of the things that they will do is they will join the iceberg and then try and catch it on the other side. That one's probably not going to work because it's way too much against the flow, but that's the kind of the trade that you would take. Maybe if it was a little bit earlier in the session. I don't really see people scalping the DOM anymore. Well, yeah, so hold on a second. What the hell? The news squawk was talking there and his voice got all screwed up. Yeah, I really don't think that you're going to make money if you just use the DOM. I think that you're really going to have a hard time making money in futures without it. But if that's all you've got, you might not really have something. Okay, so you see there, if I get lucky here, so there's not a lot of volume coming into me at 10. How many times does that work out on average? Well, okay, so I don't think. Okay, so again, I can prove there's a slightly higher chance of an iceberg holding. Okay. If you think that the point of that video was to say, when there's an iceberg, join the iceberg, and overall, on average, you'll make money from doing that. If you watched the video and that was what you came out with, then you weren't watching the video because that's not what I said. Right? What I did say was, these are some places where you can get easier fills. Yeah, that one did work out. What else would you lose along with the DOM for greater edge? Knowledge. You want to know news. You want to know what's going on in the market that day, auctions, everything that you can know, anything that you can find that can predict future orders. That's kind of the thing you want to look for. What do you have that can predict future orders? Now you come into the DOM and you have an idea about what you want to do, and you can use the liquidity to your advantage, right? So if you really watch when I'm trading, you'll note that, especially when I'm going for these one tickers in the treasury, I'm looking for places where I can get a quick fill. But you just here's the thing you got to remember, okay? Maybe I should make a video about this because I don't think that people get it, okay? if you have an edge that is based purely off of price and current volumes, well, yeah, you want the quick exit too, but you'll find that I can find some areas where I know where I'm going to get both of them, right? So like in that particular one that I had just done there, the reason why I tried doing it, even though I kind of thought it was a bad trade because we're having too much momentum going against us, is because I knew that 09.5 was being kind of flighty, right? They weren't holding a lot of liquidity at 09.5. So when they started to not hold a lot of liquidity at 10, but at iceberg, then I said, well, I can get filled on the iceberg. And if they don't tick through the iceberg, then the 09.5 is probably going to pull again and I can get a fill on the other side. And that's how I was able to do that. It's just one time though, so we shouldn't read into it. I don't think that I'm not saying, hey, there was this one trade that I just did there. If you just did that every day and you just focused on that one thing, then on average over a period of 5 years, you're going to make money. No, probably not, because the edge that you're getting from that is so tiny. And I said in that video at the beginning, the edge that you're catching here from this is tiny. But what does it do? Well, if you know that it's going to move up, for instance, you knew that the 10-year was going to move up because of auctions. And I don't know if that's why it's moving up, but let's just say that was your thesis going in. I want to buy because there's a treasury auction today. That would be a very reasonable trade, okay? We could have come in here and we could have said, buy the edge at 06.5. You catch the edge at 06.5. You now have something that you can immediately scratch on if you want to. And if the pressure continues, which it did, now you have a trade where price never went against you. Why is it doing that? I'm going to refresh the page because I feel like there's something screwed up there. Like that it's running twice or something. Right? So, is there an advantage in catching the edge? Yes, there is. That's why there are some robots out there that literally just only try to catch the edge every time. Like I'm telling you, there is a robot out there that every time that there is an edge, it hits into it. And then if it doesn't see, after so many seconds, if it doesn't see continued pressure, then it hits back into it with a scratch. You're not going to make money from doing it that way because you're not fast enough and you don't have good enough commissions and everything for that sort of a thing to work. But is there a slight edge in hitting into it when the liquidity is low and you have a clear direction? Yes, there is. And so if you are taking a larger trade based off of some sort of an informational edge and you're trying to time your entry, trying to go in and hit into the edge to try and catch the edge is something worth doing. Joining icebergs have a very tiny... That's not true for starters. But the edge is in being able to scratch, so basically the edge is for the broker. Well, yeah. I think so, yeah. I mean, it's not the edges for the broker, but it's just saying that, yeah, it doesn't necessarily guarantee that it's going to tick up next. Right? But that's what makes these trades interesting, right? You're taking advantage of the book. You're finding an edge that is based on the rules of the market and the way that queues work. And it's one that if there wasn't competition out there for it, you could make money from it for sure, right? Now, just because you can make money only from that thing, it doesn't mean that it's useless to you, right? It just means you're going to want to use other stuff on top of that. Do they have a high edge or not? So if you are trying to, if you really want to go short, if you really think that this is going to reverse here, okay, if you really think this move up is too high and there's a reason that this particular location that it should turn around because of some informational edge that you have, okay, and you see an iceberg, that could be an advantageous location to get short from, yes. And there is an edge in doing that because, again, here on the iceberg, you're going to get the quick fill. And then, you know, if you don't want to hold it, you can, again, you can scratch into it. Unless you get filled as the iceberg fails. But didn't I not say in the video, like, you got to be really careful about assuming that the iceberg is going to fail because there's only a very slight possibility that the iceberg is going to hold, right? What we do after the iceberg is kind of a 50-50. Usually they tend to get filled. They usually tend to go through at least once. Like they tend to the order, if we were doing it at 10, at least once 11 will go bid. But there's like a 51% chance that it turns around at that price. Something of that nature. Like if you take it from there and you say, does it go 4 ticks above or 4 ticks below from that location? There's a slightly higher chance of it reversing. And where does that slightly higher chance come from? You're using the cues to eliminate the disadvantage of the spread. They were taking trades regarding joining icebergs that work out on average on a 50-50 basis. If you were to try and fade, if you tried to join every iceberg that you ever saw and then tried to make 4 ticks off of it with a 4 tick stop, then you would probably win 51% of the time. Yes. That's what I'm saying. And again, if it was random, it would be like 45% of the time. So why does it come out to be 50% of the time? Because you've used the book to eliminate the disadvantage of the spread. Now there's a third one that you can do that I didn't really talk about because it's really kind of the same thing, but you can do and I guess I didn't think about it, but I really should have. You can do an alligator, right? The alligator would be like the opposite of catching the edge, that you saw price tick up and there's a few orders on the bid now and you can put your order in there so that you're at the beginning of the queue. And then when you see momentum coming back the other way, you can try and catch the edge and get out on the alligator. That would be the third way that you can try and, play the queue. But again, I'm saying if you did that, that's what the stats would be. I'm not trying to tell people you should always do this trade. No. Like, I was very explicit about it, right? I said, what you want to do is you want to combine it with something else, right? You have an informational edge. You want to take the edge. You want to hit in with a market order that it's to your advantage to hit in with a market order and try and catch the edge, right? Like I want to go long here. Where am I going to do it? How do I decide this is the exact moment that I want to click? And I'm saying, try and catch the edge. Yeah. So I'm not sure I see what's wrong with that. I don't see why that's flawed. But you see, the reason it's important, the reason it becomes a foundational principle is because if you're talking about the spread, your target is 1 tick. Well, we could do it with 1 tick. Is just for back testing purposes, there's kind of some problems with that. But it would probably apply the same way. So what I believe you're trying to say is that if you see an iceberg and you hit into the iceberg and then try and take 1 tick profit off of that on average that you will win more than you will lose, that's not true. That would only be true if we were having strong momentum, right? If you're having strong momentum, then by all means hit in icebergs. But usually by the time you see the iceberg, you probably missed a better entry, right? on that kind of a momentum trade, by the time you see the iceberg, you missed something, right? And on the split side of that, if I am getting a momentum trade like that, I would look to see an iceberg in line with the momentum. If we're trying to buy to catch the momentum, I would like to see, 10 start to trade and an iceberg there and join that iceberg. The reloading. But it is... If you have a trade that is a coin flip, then there's edge in it, though. Do you disagree with that point? Do you not understand that point? In trading, remember, random is not 50-50. Random is 40-45. Okay? Because of the spread. So if you get a trade that is 50-50, that means that you've been able to overcome the disadvantage of the spread. That means there is some edge in it. And of course, that would be a problem if that's all you had. But that's not all you have. You can combine it with all of these other things. Yeah, it is. Listen, if you take that kind of approach, you're not gonna find enough edge to do what you want to do, right? The only thing that is gonna give you this, like, you're gonna win 60% of the time, 70% of the time, given an equal risk reward and all of that thing. The only thing that is going to give you those kinds of numbers is being an informed trader. Period. But you take being informed and you optimize your timing of your entries so that you eliminate the spread, and you're able to read the liquidity to read which locations are more optimal entries. And you combine all of those things together, it gives you a lot more breathing room, right? For you to be able to come in and make the sort of a trade of trading it on an informational edge. Because the issue with an informational edge is I might know that today on average we're going to move up because it's an auction day. Yes, news would be an example of being an informed trader. Yes. Okay. So you might know that we're going to move up today, right? But what could happen? Let's go back to our chart. What could happen to you? We want to go long. Okay. And we could be doing the reading from what we did this morning, where it was like, okay, I want to go long, and then we started to see a little bit of momentum, and so I went long at 06.5, and then what happens? It comes back. It comes back. And maybe that's not such a big deal. Okay, maybe your stop is bigger than that, but maybe your stop is only 2 ticks, or maybe just it coming back like that makes you nervous and you get out, right? And so then you miss it. Yeah. Wouldn't it have been better for you to have been able to read the liquidity and the spread and everything to have caught 04.5? Yeah, that would have made it a lot easier for you, wouldn't it? And that's a difference of like 2 ticks. And of course, if that was the only thing that you had was some order flow edge, whether it was catching on, I don't remember what it did back there. We could go back and look. But, if that was all you had, then yeah, it's like it's a 50-50. But what you need to understand is that these edges kind of compound on top of each other, right? So you have this one tiny little thing that's just based on order flow or whatever the deal is. It's like on its own, it's not a big deal. But when you combine like 10 of those things together into a system, you start to get something that can be quite reliable and powerful. Okay, so your argument is scalpers like Gary Norton are lying when they claim a higher than 70% win rate. For instance, he's not trading on the knowledge of the news. If anything, he stays out with the news. You're probably not going to hit those numbers, yeah. I don't know if he hits those numbers. I've seen people show me that they've been able to do it, but I haven't seen somebody that really, like, they've been trading that for a year and they hit 70%. It's hard. It's hard. But Gary is also incorporating something else, right? Gary is incorporating correlation. So it's still not a fair comparison, right? Is it, am I wrong? I'm not sure which thing it was that I'm saying that Lucas is laughing at there. Your trade was still in the range, fell back in. Yeah, we could have bought on that initial breakout. It wouldn't have been too bad for me. I think it wouldn't have been too bad. I have to go back and look. On the interest rate, what it had done. Because on the interest rate, if it comes back like 10 ticks, then I start to go like, I did something wrong, Well, you can speak much. When you guys are responding to something that I said, it really helps if you put in a hint about what it was that you were laughing at, right? You put a reference into what I was saying, because I might say 5 or 6 things before I can see your messages. Right. But to the point, and here's the thing that you really won't be able to see from the videos yet. But when we get through all of them, that you should be able to pick up on, okay? And that is when we're talking about catching the edge in particular. What is it about that? What is it about that makes that work? Well, there's more on the bid than there is on the ask. And therefore, all other things being equal, if we're getting a certain amount of sell orders per minute and we're getting a certain amount of buy orders per minute, and those forces are equal. Oh, okay. I get you, Lucas. Okay, good. So here's the question for you then, Lucas. What could I have said in that video that would have made that more clear? That would have made that more clear. I don't know. So anyways, let me try and explain something. So there's 4 forces, right? Gonna make a list down here. There's 4 forces, or there's 6 forces. Okay. Market buy, market sell, limit buy, blah, 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 right there, limit sell. Limit buy cancel, limit sell cancel. Okay. These ones are bullish forces. These ones are bearish forces. Right? So, if we have the situation where we look at all 6 of these forces in a particular situation, say that since we're not really getting into this changing around, I'll do it down here. This is 2000 and this is 300. Okay. 300. Okay. So that's the limit buy force and that's the limit sell force, right? Now, there's going to be a certain amount of limit orders that will cancel, right? Let's assume, though, that all of the other forces are equal. That means that the number of orders that cancel at this price is equal to the number of limit orders per minute that cancel at this price, right? So, and the number of limit orders that will add at this price is equal to the number of limit orders that add at this price, okay? And the number of market buy orders that come in is going to be equal to the number of market sell orders that are going to come in, okay? Under that circumstance, with all else being equal, what is most likely to happen? The 300 is going to get taken out first. That's the most statistically, mathematically, we can prove that that's the most likely one to tick up. That's the most likely thing to happen, is that it's going to tick up because you're more likely to hit 300 buy orders than you are to hit 2,000 sell orders, given the random stochastic volume amount with a certain rate, right? That is straight up. It's a higher probability for it to move up. Okay. So why is that important? Because it helps you understand how the changes in these forces will actually affect things, right? If there was more market sell orders coming into the market than market buy orders, then all of a sudden it's different now, right? And it kind of depends on how much of a difference those market sell orders are in order for them to take out the 2,000. But if that happened, it would probably cause some of these orders to cancel, right? So some of these will have correlations with each other. They kind of will make these things change, right? Okay, well, why does it matter if the 300 gets taken out? You want a certain fill hit the market. Why do you care about getting filled if there's no edge in exiting at a profit? Well, okay, but if you don't, because here's the thing, is that if you go into this situation and you say, okay, what is it more likely to happen? That we are to tick up and we are to tick down. We know that it is more likely to tick up. So if you take that trade and you buy at that price, then it will tick up. And worst case scenario, assuming you're close, because it could tick back down and you miss it. But we're saying you're only going to give it a few seconds and you're going to hit back into it if you don't. Okay, so worst case scenario, you break even. Whereas if you look at this situation and you say, I'm going to sell, then it ticks up and you've lost a tick, right? In order for you to lose a tick doing this one, it literally has to not move up and then tick down on you. So the number, when you're taking that trade, if I'm going to hit this one and you're going to hit this one, I'm going to 50% of the time break even and 50% of the time make money. You are going to 50% of the time lose money. Right? Right? 50% lose, 50% it goes further. Whereas this time it's 50% lose 1, and this, 50% lose 2, and maybe 25% lose. I don't know. I'm probably being a little bit too generous for one side, huh? You say you can only benefit, but I mean a lot of trades out there happen because of that, right? And that's the thing, is that, am I saying take that trade all the time? Not necessarily. I mean, I do think that if you're taking a larger trade, you do want to use that stuff. Yeah, you do. But why it really matters is because these robots trade off of that. And if you don't understand that, if you don't understand why the robots do that, then it's really hard to understand the larger picture that goes on in the order flow, right? Especially this particular situation where there's a spot where there's less, right? Because if I catch the edge, maybe let me try doing it here again. If I catch the edge, 50% of the time I break even, 50% of the time I win. So that's BE, 50% of the time I win. Okay. This situation where I lose doesn't happen because I just hit back and I break even. Whereas if I hit into the 2000s, okay, and I'm never catching the edge, that means that every time that I put my market order in, it has not ticked down, right? So at that point, what is the probability that it's going to tick down? I don't even think that it's 50%, right? But if nothing else happens, I lose. There's a one where let's say that it's 50% of the time I lose money and 50% of the time it ticks through and I make money, right? Right? Then on this guy, he makes one tick 50% of the time on average, whereas this guy basically makes 0 on average because half the time he wins and half the times he loses. Should you trade that way? Not necessarily. But does it explain why the robots do what they do? Yes, it does. Why do you have to pretend? We're just setting up a situation to prove mathematically why there's an edge in doing it. And that's that's the first key observation. There is a mathematical edge in catching the edge. If you catch the edge, of course, if you hit into it and it doesn't tick up, then that's a different thing. But if you catch the edge, there is an advantage in it. There is a straight up provable, right there with the math, advantage in having caught the edge. What's the advantage? You have the ability to break even. So now, not all of your trades are losers. A good portion of those are break evens instead. And that improves your expectancy of your system. Okay? It is enough that you could make money just off of that. If you're a robot and you were connected to the exchange and you were the fastest and all that, right? The heuristic about scalping is you need to know when to enter. Yeah, well, because the really, I think the bigger key here is why should it continue to tick up? If you catch the edge, why should it continue to tick up? If you're a robot and you know you're always the fastest and you're always at the beginning of the queue, and if any orders come into this next price you're going to get filled, then yeah, go for it. You're going to make tons of money doing that, right? But if you're a human, that doesn't really make sense. You need to have a reason to think that there's going to be more orders that come after that, right? But that's why I said you combine it with a larger informational edge. You know, the best trades that I've taken have been there's a piece of news, I'm fast enough, I catch the edge, and then it goes. And there's those where it will come back, but that edge will still hold. You know? Or if it doesn't, I just break even. But you're giving yourself a much better chance when you combine all those things on top of each other. But that's not necessarily the thing that I'm trying to, the case that I'm trying to make. The case that I'm trying to make is, why does that happen? Why does that happen? Because the robots know that there's a mathematical edge in it. So now that you know why the robots do what they do, now you can watch it and you can make judgments about what's going on here, right? I can come in and I can say, well, 3,000 went into '08 half. There was an iceberg there. Why did you see that? Why did you see that happen? Why would they hit into the iceberg? Why would they hit into the iceberg? Because they thought they were going to catch the edge and they got caught. Does that mean that it's going to go back into '09? No, but the guy with the iceberg probably has a little advantage there. So, you know, if I see it go through the iceberg and I immediately see a lot of orders hit at '08, then all of a sudden I know, okay, these market orders are for real. And then I'm way more likely to go in and try and click in and catch the edge at the next price. Although, you know, I kind of have to judge it based off of like how many market orders have already come in and how many are likely to continue to come through, right? But the key is you got to understand the six forces and the impacts that those six forces have on price and the impacts that they have on each other. And then you can watch those six forces, you can notice the changes in those, and you can make determinations about how that affects the order flow, and therefore what is the most optimal price and location to try and get in at. Or, more importantly, to determine if your larger market thesis is being verified or rejected by the current order flow. Right? There was an iceberg there at '08. It held. We've ticked back up. Is that supportive of the theory that we're going to continue moving up until the auction? Yes, it does. It does support the theory that we would continue to move up until the auction. That's not my theory right now, but if that was your theory, it would be in support of that, right? Whereas if we had traded down through that and we started to see a ton of orders start hitting at 07 half, what is that? That is now market orders, a change in one of those forces, a change in market sell orders. That's a big thing. Market sell orders overwhelming a high amount of limit buy orders. That's also kind of a significant thing, right? And then if 07 half pulls, now we've got limit buy orders canceling. So those are all three of the things that affect it are in favor of the bears, right? That's not in favor of my larger thesis that they're going to continue to go up. It's very aggressively not so. So maybe when that starts to happen, I have to start thinking about, well, why is that happening? Was that maybe that was too small of a move? It doesn't matter. You might try and justify it in your head, but at that point you would have to say that no, like none of those things were in favor of my trade. So maybe I'm wrong. Maybe it's not going to move up just because of the auction. Maybe the auction doesn't matter that much today. Yeah? You befriended corn today and it paid off? Well, where are we at in the ES? The ES did recover. You know what? My initial trade that I took in the ES, what was it? 82? Was not a bad trade at all. That's frustrating. Are you saying the impact of the news is not? Well, no. It should be invisible in the book. That's the whole thing. If you have a piece of news and you think that piece of news is bullish, but then all of those 6 forces that you look at are all giving you bearish signs, then you must have interpreted it wrong, right? Or maybe you just need to wait for the next wave and then see, and right? Because then the next step on top of that is judging those changes over time to say, here's what it was doing on this leg, here's what it was doing on this leg, to kind of judge how strong those forces actually are over the longer term. Because what you're really trying to determine is like, what is the latent liquidity actually doing? You can see the resting liquidity. You can't see the latent liquidity. If you were a soy boy, you would have done better. Yeah. But this is the thing, is that like, if we look at my strategy, for instance, informed trading has done pretty well for me. I've made some mistakes. That's, I think, something, if we're looking at, like, if we're judging how this strategy, how good my current way of doing things are, I think that we really have to look at those big mistakes, because those were situations where I think in both the instances, I had either missed something or I was wrong. My understanding about something was wrong. So those were true mistakes. Okay. You're always going to make some mistakes, but I should make less mistakes than that. Okay. So we got to factor that in. But just going off of how I've performed now, I'm making a little bit more than my costs. Okay. If I didn't have all of those order flow edges, what would be the difference for me? It would be a tick here and it would be a tick there. It would be like, instead of being, instead of having made a little bit more than my costs, I would be losing a little bit more than my costs, you know? You know, being in the right instrument for the day is a big edge, right? Can you give me an example of when news contradicts the book flow? Well, yeah. So, for instance, when we had really good, so there's been 2 of these. So the last non-farms payroll, we got something that should have been hawkish. We got the last non-farms payroll was really good, and interest rates decreased. Why did that happen? It was what we got in the flow was wrong. So I tried taking the trade, and then the flow was wrong. Because the flow was wrong, I got out earlier than I would have otherwise, and so I minimized my losses because of that. Okay, but it could have been much worse, and it was still a mistake, right? Now, in that case, why was it? I think in that case, it was because the rumor that Boehner had interviewed with Biden was going out. I think that's why the treasuries went dovish that day. And I didn't find out about it until the next Monday. So that's when that one was, right? Because it could be you're wrong, or there could be something that you don't know about, right? What was it? It was my reading of the non-farms an incorrect reading. Well, that's a possibility too. I think in that case, it wasn't that my reading of non-farms was wrong. I think there was another piece of news that came out that I didn't know about. Now, the non-farms payroll before that was bad, right? That one was bad, and rates increased on them, if I recall correctly. But maybe it was the opposite. I can't recall. Anyways, and that one was just kind of confusing. But in that particular case, I think that I was right. I don't know why the flow did what it did in that particular instance, but you got to watch the flow. And you got to say, is it confirming or rejecting my thesis? In that particular case, it rejected my thesis, but then the next week it came back in line. And in that particular case, we were able to see that the flow was starting to come more our way, and we were able to get some of those losses back. Actually, I think we did completely make back those losses. Makes sense? What I'm saying is not really a very organized explanation, but that's kind of where we're going, and that's the explanation that I'm going to be trying to make to you guys in videos 4 and 5. That's really video 4. Video 5 is going to be about the real market tendencies, right? Video 5 is going to be about volatility, order clustering, square root law of market impact, inverse law, and how liquidity holes are formed. Mechanically speaking, how can someone outside of the book cause the book to move the other way? Does it mean CME is not a centralized exchange? No, in order for you to move the book, you're going to have to put orders. You're going to have to take one of those 6 actions, right? You can't place an order without being seen in the book and in the CME, no. Does means I don't get why you're asking that question. We're back up at 09.5. It's kind of, you know what, it's funny when we're talking about icebergs, because I really got to make it clear, and I really tried to make it clear in that video. Do not sit and assume that icebergs are gonna continue, because you can make money in the long run off of a strategy like that. Like there was a time where like that was literally what I was doing, was taking icebergs and holding them, and if I had continued to do that, maybe I would have made money from it by now, but it is not very reliable. Like the consistency of that strategy is not very good, right? You'll get periods where the icebergs always hold, and you'll get periods where the icebergs always get broken through. And it's kind of weird today that we've gotten a day where the icebergs have held, right? Because we had it up there at the top where I had taken that one tick between 10.5 and 10, and then we got another one down there at the bottom when we got the iceberg at 8. But it doesn't always work that way, and there will be periods where it will do those things. That's where, again, like if you were going to write an algorithm to trade just on the book, and hey, if you're writing an algorithm and you have like a co-located server, it's possible for you to make a system that uses those 6 forces. You take those 6 forces and you plug them into a machine learning method of some sort, and you have good fast execution. You could make money from doing that, just from that. Yes, you could. There's edge in it. Can you as a human do that? No. But does it help you as a human to know how that works? Yeah, it does. And it doesn't give you as much edge as it gives the computer, but it's a tiny little edge. And you combine that edge with this edge and with this edge and with this edge, and it's all of those little things put together that's able to make a profitable system for you. Because I think what most retail traders try to do is they try to say, I want this one setup, and if I find this one setup that is consistently profitable, and that's how I'm going to make my living. And I'm telling you guys, if that's what you're looking for, I'm not saying that it doesn't exist out there, but you're going to be searching for a really, really long time. And then you're going to find it, and it's going to work for 6 months, and it's going to change. Right? It's really hard to trade that way. That's why I say instead, here's what you do. Gather as much information as you possibly can. Any kind of a market tendency, any kind of a little thing that you can find that can help you, and you can incorporate that into your system. And if you incorporate 100 tiny little edges together, that's going to be a lot easier in the long run. I know it's complicated to execute on, but you know what? It actually isn't, because you're practicing it every day, and you're doing it every day, and you start to incorporate those things into your thinking without even thinking about it. So it doesn't actually impact your ability to take a trade, okay? But I'm telling you, it's so much easier to develop that than it is to go and find that one little setup that's always going to make you money. Now, you might say, because I think you're probably saying, well, yeah, but didn't this one guy do this or one guy do that? You can get lucky. And that's where kind of the problem comes in, is like, I can have two systems. This system is based on empirical evidence, and this system was not. It was, this seems to be working right now. Like, I just randomly stumbled upon this thing, and right now I'm making money from it, which is basically the way the Ace found things, right? Okay. And you take those two systems going further. Which one do you think is more likely to continue being profitable a year from now? Right? What happens when the market changes? Because we're in a weird market, aren't we? Aren't we? Why am I even asking that question? We're in a weird market. The past 2 years, any person, I tell you, this is the thing that drives me crazy the most, is there will be these threads on Reddit, and they'll be like, hey, what was it that got you to being profitable? And then there will be this guy that will say, well, I started trading, but then in around May of 2020, I just started doing this, and ever since then I've been profitable. And I'm sitting there like, you have to be an idiot to have been trading stocks and not made money. You're trading other assets, like you're trading treasuries, that's a little harder. Okay. You're trading E-minis, depending on how far your stop is, that's a little bit harder. But if you're like trading stocks and you're swinging stocks and you have not made money, you're doing something wrong. Like, you are just, because it is so easy to make money in this environment, and to say that like you've been consistently profitable over that time period, it's probably a factor of the market and not anything to do with your signal. And when we're not in that environment anymore, which it looks like it's turning, okay, where it's not free money all the time, interest rates are going to be increasing perhaps very, very quickly, and markets might become very constrained. And if they don't become, not constrained, but volatile because of that, and if they don't do it because of that, well, the other option is that things just become very low volatility and choppy, okay, which is probably even a worse problem for a lot of especially the trend following strategies, right? You go into that environment, this ain't going to work anymore. If you base your system off of empirical evidence, and you understand the way that the market actually works, and you came to an understanding of that system based off of a real understanding of the empirical research that we have found about how markets move, you can adjust this system. This guy won't know what to do. Yeah. So this whole big spill, oh my gosh, I'm like way past this whole big conversation. That's the point, right? Use empirical evidence to trade, guys. I know it seems like it's easy to just go and find this guy that sounds like he knows what he's doing and just follow him. But I'm telling you, I've been doing this for a long time. I've seen a lot of people come and go doing that. So, I'll see you guys tomorrow. Stay profitable.